Most people think you need your own income to qualify for an investment property, but the truth is, some banks don't really actually care about your income because there's one specific loan that you can literally qualify using the renter's money. If you've ever wanted to buy real estate, but your income is too complex or inconsistent or it's non-existent on paper, this particular loan is a game changer. Hi, we're the Clear Close, the mortgage experts that get you clear to close on your next investment property rental. Our team collectively has funded over $1 billion, specializing in business purpose residential real estate. And if you want to skip this video and go straight to booking a call with us, there's going to be a link in the show notes, pinned comments, or you can use the QR code that's popping up on the screen right now. But if you have the time, watch this video all the way to the end because this video is going to be a comprehensive overview of a DSCR. We've covered this topic in the past many times before, but we want to have a video in our video library that someone can go to and say, okay, I want the definitive overview of DSCR. And I think this video is going to be that premier video on YouTube.
You want to start off with a solid foundation because there's a lot of information out there on how people are financing their properties and their rentals. So this is one where it's thrown out a lot, but it's a dynamic marketplace. So let's dive into it.
All right. Let's cover what a DSCR actually is. We've gone through it, like I said, in previous videos, but for the purposes of this, this is a standalone video, we're going to go over it as quick as possible. So number one, a DSCR, it simply stands for a debt service coverage ratio. It's a term that was borrowed from the corporate world or the commercial real estate world. It basically means that the debt can be serviced through the income of the property, right? So it's not your income that's qualifying you. It's the income that can be generated from the property that qualifies you.
Exactly. So it's a fancy way of saying, does that property in question make enough rent to cover the mortgage? And that mortgage, your payment you're covering is the principal, the interest, taxes, insurance, any other dues if it is a rental in a HOA community.
And if this sounds kind of like a cheat code to you, it kind of is like a cheat code in the real estate world, but it's not like a one size fits all type of deal, right? Like these programs differ depending on the lender, and we're going to go over that in the rest of the video. And so why do your investors like DSCR, Jason?
There's a lot of benefit beyond just the fact that it's an investment property. But the more common one is it's not your personal income that's being used to qualify you for that rental property, because there's going to come a time as we hit these different sections where your only choice is a DSCR loan. And if you don't know what this is, you're limiting yourself on future opportunities because there's caps, there's restrictions like with debt to income on your personal earned income to qualify. You can close in an LLC. You cannot close a conventional loan in an LLC, let alone an FHA or VA loan. So you get a lot of protection in that regard as well. And there's no limit to how many DSCR loans you can have. It gives you the opportunity to have faster closings, faster deals, and more importantly, more opportunities.
Yeah, like I think the limit is what, 10 or 12 properties for a conventional loan? 10 properties, right? So yeah, and that means the person that has 10 properties in a conventional, it took a long time for them to get there because they had to
Very long time.
Yeah, they had to season each one, right? And then they had to show income.
Down payments requirements, right? Like,
right.
You have to you could put down as little as 20% on an investment property conventional loan. But to be able to save up enough money, either through cash flow, you'd have to have a very high income stream as a W-2 wage earner to be able to put down a home every year, once or twice a year. Like if you're trying to put down like a $400,000 or buy a $400,000 house with a conventional loan, every year you're putting an extra $80,000 down plus closing costs, plus reserves and all the other requirements that a conventional loan requires you to have per every property you have financed. So that's going to make it even harder as you get to the 3rd, 4th, 5th, 9th, and 10th property, because you have to have reserves to cover all of that. So it's not an easy way It's very rare to see someone with 10 finance properties through conventional loan.
We do talk about HELOCs a lot on our channel because let's say the person who wants to use a HELOC to get their first rental property, they can do that. They can take out a HELOC, put that towards a big down payment on a initial property for, to rent out and become the first step in their investment. Um, but DSCR is kind of a different beast, right? In a HELOC, you still need to qualify for the HELOC.
Yeah, no, it makes sense. Like it's a combination play. It's not just a HELOC for a down payment. Like I have clients actively doing that right now. They're taking out HELOCs to either A, be the down for the investment property that we're going to put into a DSCR, or take the HELOC out to improve the properties that they currently have, increase the value and rents, and then cash out refi into a DSCR loan that we're talking about here to get more capital to build the portfolio. So it's like you're playing chess at this point. So if you're in a highly growth phase, you're going to want to leverage the best options for like rehabbing a property.
Right.
Definitely look at HELOC because you can reuse those funds over and over on every single property you have in your portfolio, and then you use the DSCR to put long-term financing on it at possibly better rates and terms.
Yeah, that's a really good point. I think most people that are just getting into real estate investing, they don't understand that you can combo these different mortgage products like HELOC or maybe even like a hard money loan, depending on your situation, plus a DSCR, right? To achieve the portfolio that you've always dreamed about. It's not just like I have to use this one tool to get to my end goal. You can use multiple tools to get to your end goal.
No, it's true because like people don't realize what they already have. Like the most recent example is one of our local customers. They have like multifamily properties next to each other. And with California laws, you could put in ADUs as an example. I know we've spoken about it in the past. Like you can take out a HELOC, improve your property, build an ADU, refinance it with the DSCR because you're going to have additional income stream coming in, and now your home value is worth more. And then you have the ability to use that to fix the other property and repeat that, or possibly even take that equity or line of credits through a DSCR or combination with the HELOC, and then go on to the next project, right? And you're actually cash flowing better than you realize. And a lot of the times, these opportunities are in your own backyard, quite literally. So it's pretty amazing when you really take the time to learn what your options are, and then you can actually spend a moment to reassess your portfolio. And if you need help reassessing your portfolio, call us. We'll see what we can do and see from our experience working with hundreds, if not thousands of investors over our careers, see what they've done that we may be able to help you with, because you might already have the perfect starting point to catapult to the next level. It's just you didn't have the right tools. You didn't know that these loans were available. You kept going maybe with your local private money lender and kept paying them 3, 4, 5, 6, 7% origination fees every time for those
Mhm.
projects. When you could have used the HELOC and you could have been the bank yourself and saved yourself several tens of thousands of dollars each year.
Yeah. We have plans to make more videos in the future with these advanced strategies of, combining different mortgage products together. And that's something that we'll provide for you guys in the future. So, please subscribe and stay tuned with the updates of this channel. Check out our playlists on our page every so often to see if there's been any updates. We're going to spend the whole year of 2026 looking forward building out a library and different playlists for you guys that have different interests. Whether you want to be an investor or whether this is your first time buying a home, we're going to have a lot of tips for you as well in those kind of playlists and specific products like HELOC or DSCR. So we're building out that library for you guys.
Looking forward to seeing you guys grow. It's been
Yeah.
an amazing 2025. It was a horrible start to the year, but seeing, looking back at it, seeing how strong like our our clients are, it's pretty crazy. Some of the growth that I've seen from like our clients this year. They took $400,000 HELOC, $500,000 HELOC, $300,000 HELOC, and they've enhanced their portfolio with renovations. They're done with the projects now. We're looking to turn them into long-term financing going into next year. reset that HELOC, increase rent. It's amazing once you educate yourself on what's out there and then you partner with the lender like us that understands what your long-term goals are. And it sounds like another sales pitch, but I'm telling you, you can take what you got from here, try to implement it somewhere else. It's very different when you work with seasoned brokers like Nikki, Peter, and I, and on our team. It's night and day.
Yeah. And speaking of Nikki, she's a true veteran. She's an invaluable part of the team. I know she hasn't been appearing on the screen in a while, but she's still part of the team. She's just a little bit tied up with other
Big
business,
projects
big projects that she's working on. So,
and big
uh,
investments. So one
yeah, yeah,
we'll get her to share it one day.
exactly. So, Nikki, if you're watching
Maybe we
this,
should show a little sneak peek, Peter.
yeah.
I'll send you one of the projects. We can do like a 10-second clip just showing you what's going on. So
All right. So let's move on to how this thing actually works. Let's go into the numbers part of it. I know we have a lot of viewers who enjoy actually when we throw up an Excel screen and show them the math. The basic formula that you guys have to keep in mind is the gross market appraised rent or the actual rent of that property divided by the total monthly mortgage payment, including the interest rate and including the property taxes. And that gives you this ratio, this number. And we call that the DSCR, the debt service coverage ratio.
correct. So if you want to since this is one of our evergreen like educational series, we'll go a little deeper, right? So when it comes to gross rents, what that means is we look at our lender's perspective, we look at the appraisals assessment of the gross market rent in your home for a home of your type. We'll look at that versus what your actual rents are if you are receiving rents, and we'll use the lower of the two to qualify the property's ability to repay the debt. And then when during underwriting, we'll review what your actual mortgage payment principal and interest look like, confirm what the taxes and insurance are, and if any association dues are applicable. And then we'll take that total and divide it with the gross market rents we confirm. So that gives you the magic DSCR ratio we need to hit for a specific loan program. Typically, the DSCR ratio we're looking for is 1.0, is what everybody markets. And from there, as an example, say your gross rents are $2,500. Your expenses for taxes, insurance, and HOA are $400, mortgage payments $1,800. So that will be a DSCR calculation of $2,500 divided by $2,200, giving us a ratio of 1.14. And that ratio is above the requirement of the typical 1.0, which means we have a loan that works. Simple. That's the simplest calculation of any type of home loan out there that you and I have probably, if you're a current homeowner, you've ever seen. Because if you're trying to qualify for a new primary home, they're looking at everything, like your full credit report, your debts on there, your car payment, your student loan payments, your new mortgage, everything you financed with the firm, and all the other stuff, right? But remember, the mortgage industry is constantly evolving. So DSCR loan programs from 3 years ago no longer exist today. And some of the loan programs that are marketed now will be different 6 months ago, because there were a lot of companies 3 years ago offering no ratio DSCR loans. And unfortunately, they all went bankrupt. So it's a dynamic landscape. As the markets shift, companies come and go, and it's always going to evolve. And that's why you want to work with a broker, again, because we have the ability to shop and vet all of the different lenders out there offering these products. And if it doesn't make sense to me, and you find them on your own, it might not make sense. You might not be the right product. It might not be the solution. And you may have been turned down because the lender you've worked with only had a specific type of DSCR. But we have different variations. We have different partnerships with over 100 different wholesale partners in this sector.
Yeah. Just for example, I had a customer who was inquiring about a DSCR, first time getting into the game of real estate investing. So he just asked, "This is a property. Can you help me out?" And we were able to, properly guide him through the steps. Unfortunately, it didn't work out for that specific deal, but we gave him the next steps of like what he needs to do or take care of, the type of target that he should be looking at, and helped work with him on a roadmap to get him to a place where he can become a real estate investor. So that's the type of relationship and value you can get from working with the Clear Close.
Just briefly, right? Just to give you an idea, the reason why we like the DSCR program, it's not just because you can't get a conventional loan, or you could get a conventional loan, but it's perfect in my eyes for growing investors that really want to get away from the rat race in the future, like the self-employed buyer. You may have great income on paper, on your business, but you have a world-class CPA that's great at minimizing your tax liability, right? So
Hmm.
you may be generating a quarter million, half a million, $1 million a year, but you're not paying a whole lot in taxes because you're reinvesting in your business, right? So you're not going to get a conventional loan. It's not going to work. So DSCR lets you add that as a layer of a new tax strategy, I guess you could say. So you definitely want to consult with your CPA on it, but real estate investing could be done using our DSCR program to supplement what your amazing work is with your tax strategies with your CPA. And then you have the first time investor with the W-2 income, right? You might be planning long term. You could do the W-2. And you could be a $60,000 a year W-2 employee or 160,000, right? It doesn't matter. The only reason why we bring it up is eventually you're going to come to a point where you want to get a rental property and you want to leverage the benefits of an LLC and that layer of anonymity, right? So that you protect your assets. So yes, you may have been able to do it with the W-2, but you want to take advantage of a DSR and close in an LLC for your future
Hmm.
portfolio. And then
Yeah.
lastly, like the more common one is the busy professional. Like you might be a doctor, right? Or surgeon. And again, it's like a combination. You might be self-employed 1099 or W-2 or maybe a high income earner and a principal engineer at Google. I don't know. It's just or Amazon, right? And then from there, it's like you don't you don't want to go through the rigors of having to prove or document your your stock options or RSU income, all of the other types of benefits you get. K1, it it's it makes it so much simpler for you to get to your end goal. And
Hmm.
some of these programs right now, the way that there's so much competition that the pricing is so good. Like you'll be getting conventional loan pricing in some cases when you put the right amount down on a home. And if not, some are even better. I've seen some amazing pricing options that beat primary home loans on a DSCR. But again, it is a while, but people want that rate on a 15% down DSCR with the highest levels of leverage. It's like, it doesn't work that way. Like you get rewarded for higher down payments, higher cash flow. It's like, what kind of risk do you layer into your portfolio? And the lenders are not blind to it. Underwriters aren't
Hmm.
blind to it. They're smart. And then it's some of them, it's like pretty amazing. Like seeing them, I don't even want to say it now because I know it's going to improve later as the markets change. But imagine what your best primary home rate is that you've heard of in this market, and you'll see I have a DSCR program that probably will be lower than that for the right ratios and customer. It's pretty nuts. And again, it's depends on your portfolio. It depends on your goal.
Yeah. And if you're thinking, oh, I can get a DSCR loan and then move into that house, like, no, you can't do
No,
that. That's
no,
mortgage
no,
fraud.
no. No, that won't work. The moment the servicing department sees that homeowners insurance go from rental insurance to primary insurance, you got a problem.
Yeah, no, don't do that, please. Yeah.
Yeah.
um, let's talk about some misconceptions. There are people who think, a DSCR loan, it sounds really great, but this just sounds like something that big investors do. People that have already 2 or 3 or 4 rental properties under their belt, and then they scale with it, right? But that's not true. Jason, like, Out of all of the DSCR loans that you've done, what would you say is a percentage of like first time DSCR borrowers?
Hey, almost more than half, right? I believe if you look, if there are like some reports that I've seen that like more than 60% of investors are first time investors using a DSCR program, and the market for this type of loan program going forward in 2026 is about 3 trillion in
Mm,
some of the reports I've seen. So there's a lot of opportunity for people. The reserves are a huge part of DSCR, like common misconception, like I have to have enough reserves for every property I own. You don't. You only have to have enough reserves for the home that you're buying or refinancing. So subject property, most of the lender programs out there only require reserves on the subject property. You don't need to cover everything in that portfolio, if that makes sense.
that's interesting. I guess if you're buying all the houses on the same street and you're DSCRing it, and then somehow the rent in that neighborhood just like plummets to just ungodly amounts, then you're in trouble. But how rare is that, right? Like that's almost never gonna happen.
Is it? I don't know. I never
I
thought
don't
about
know.
that. That sounds like a doomsday scenario. I hope it never
Thinking
happens.
I'm just thinking why the requirement would not account for a reserve for each house because they're assuming all of the houses are not gonna be unrentable at the same time. Like if you have a problem, it's gonna be isolated somewhere.
Could be, but conventional loans, you need to have reserves for your primary and every other property you own, 6 months, depending on your
Mm,
FICO score, right? So it's like if you had 10 properties, that's 60 payments worth of mortgages you need reserves for. That's nuts.
mhm.
If you have 10 of them financed, right? DSCR, you only need it for the one subject property in most cases. Most
Yeah.
lenders have it designed that way.
Well, I mean, that's a good segue into our next section, which is comparing, like we want to compare DSCRs to other ways to get to the same destination, which is getting a rental property, right? So, like you said, the more conventional loans that you have for multiple doors, you need to have that much extra reserve in your bank account. Whereas DSCR, you only need the reserves showing for the subject property you're doing the loan for, which is a huge like benefit to cash flow.
Of course, because now you're not scrambling trying to hit requirements to get access to a loan that's very restricted. It's almost designed in a way that it's like you're not supposed to get to 10 finance properties. It's very rare. I've seen them, but it's
Yeah.
like the only people I've seen them with are like ultra high income earners, right? That work for Fang. And they have multiple properties that way over time. And they're all short-term rentals too,
They probably
which
never
is
even
funny.
heard of DSCR. If they heard about DSCR, they probably be like,
They
"Ah,
say
why
it's
didn't
not
I
well,
do this?"
no, it's like mixed. It's a mixed cam. It's like I can't change out. I can't go to DSCR yet. I can still qualify for conventional loan, but I want to go to DSCR eventually. And then I'm like, well, too bad all of these homes are done conventionally and closed in your name because if they're all rentals and something happens, they'll see your assets. So it's
Yeah.
like it's a trade off. It's like, what are you gonna do? 1031 out of them into LLC? You're gonna come to a point where you got to make some changes to your holdings.
Another thing that a lot of investors like to do is a fix and flip. Like, we watch those HGTV shows, Fixer Upper, and a lot of people that I know that wanted to get into real estate, they wanted to flip homes, like buy it when it's distressed, fix it up, and then like list it for sale.
Yeah, I mean, you're not going to buy a property with a DSCR loan thinking it's a fix and flip because if it's a fixer,
Right.
it's definitely not going to qualify the program. But
Hmm.
it's going to segue into our next section, next videos downstream, where we talk about bridge loans and fix and flip loans. And once your home is completed, you could then go into DSCR. So it's like there's
Yeah, you
actually
go. Hmm.
yeah, and then every DSCR lender, as I mentioned, is different because they have different rules. And a lot of people out there still think I bought my fix and flip or fix and hold. I have to make 6 payments with this fix and flip loan, and then I can do my DSCR. That's not the case. I have options and lenders where you can finish that flip or hold and rehab the property be done in 3 weeks, and I can refinance you out of that temporary bridge loan. You don't have to wait 6 months or pay 12% interest on that thing for 6 months. When you're done, I can get you out into a real DSCR loan right away without that seasoning requirement. So if you're the investor and you want to grow your portfolio, you may be passing up on deals like that one because oh, I've experienced this. If it's a good fix and hold, but man, I don't want to pay interest on that thing for 6 months or 6 payments. They may not have penciled out for you. Now that was all because you didn't know that there are options where you can rehab and flip that thing real quick in 3 weeks, and then we can put it into a DSCR loan if the numbers work. So yeah.
Yeah. I think another one is that's really similar, I guess, in terms of strategy, is the HELOC, right? So HELOC is taking a home equity line of credit. It's basically a cash out refinance from your existing primary home. And then you get a line of credit based off of the equity position. A lot of people use the line of credit to put a down payment on a home that they want to acquire for rental purposes. And then the mortgage payment is covered basically by the renter. And if that cash flow works, then they'll do it again. They'll HELOC. We call this a BRRRR, right? They'll pay back the HELOC, or they'll refinance the new home, and then they'll get another house. And then they'll just like continue on this domino effect.
Mm-hmm. Yeah, and like the HELOCs can be used. It's not, and just to clarify, it's not just on a primary home. You can get HELOCs on your rental or investment properties,
Right, of
or
course.
second homes too. So
Mm-hmm.
if it makes sense, and it's a great leverage tool, not just to acquire properties, but to use as funds to enhance your portfolio and holdings. And like DSCR is good once you finish that to put it into a long-term hold. Because again, you see opportunities, like you may have bought it as a flip, and I see more often than not, people are asking me after they like finish the project, they're like, wow, that actually works out better as a hold, and we'll just turn that, instead of putting it on the market, we'll just put a long-term note on it with a DSCR loan instead,
Mm-hmm.
and just benefit. Like, because this is the other strategy too. It's like, if you think your market's not good for a flip, you may have no choice but want to hold it for 2 to 3 years to see if the market turns back up. Because then now you can collect rent and get appreciation for market shifts.
Both options are good. Like we said, we're gonna have future videos where we talk about these two different loans in conjunction, but they are not the same. All right. So Jason, when does a DSCR not work out? Like I mentioned earlier, I had a borrower who was inquiring about a property and it just didn't work out. So what are some of the roadblocks that you've run into where, like, I'm sorry, you had a good thesis, but unfortunately because of X, Y, and Z, we can't do the loan.
So where does DSCR not work? Let's look at it. There's 2 sides to it, right? There's the tenant side, or the buyer side, the investor side, and then the bank lender side. The lender side, for example, it doesn't matter if that's a $50,000 loan amount or $1 million loan amount. The expenses for the bank to fund that one loan is the same, because you still have an underwriter, processor, title companies, research, third parties, everything involved to do $1 million loan. That cost is the same over there as it is a $50,000 loan. So that's why lenders in this segment have minimum requirements on loan amount. It's a business that they're running. So for them, if it's not profitable to write 30 of these $50,000 loans, because you need to put that same underwriter to do 30 times the work to reach the same loan volume, dollar size, then it doesn't make sense, right? So DSCR lenders will typically not offer anything below 100, or some of them are even raising their minimums to 150,000. The 2026 landscape is going to change on minimum loan amounts. And then flip side, as an investor, you're seeing all these amazing properties, right? In terms of numbers, at least, it looks really good on paper because you could be able to buy them for 30, 40, 60, $80,000, and they cash flow $700, $800, $900 a month. So you like cash on cash return. I want to pay this home off in 2 years just from the cash flow. But you got to remember too, the reason why it looks that good is typically it requires a lot more maintenance. It's very deferred property, or the community is not desirable. It's like a C-class investment property. It's like not the best tenant out there, but in return, you're getting a higher rent. So when you look at that, it's like there's a reason why the two don't meet.
Yeah, in a higher risk environment or a higher
In
risk
a higher risk
neighborhood.
environment. Exactly. And it's going to be probably a property that doesn't, the other side to that too is the home might not appraise well. There's a condition, like minimum condition requirements on them. And if it's a C5 with a ton of deferred maintenance, it won't work on a DSCR loan. I've seen some come back at C6. It's like basically falling apart. It's like it's done. And it makes us as a lender sometimes look bad if we're relying on the customer, our clients, to tell us the condition of the home, what the market rents are. Everything looks good. But then it's like when we send an appraiser out there, it kills me when when I get an appraisal back, I'm like, but this is not what you told me. And you told me this was a renovated home and it appraised out of C5, C6. We don't have a loan for you, like the appraisal, like, did you do your due diligence to really see if this was the right property to get a DSCR loan for? And one of the misconceptions is conditions of the home. Like you're not forthcoming, or you don't realize because you trusted your real estate agent that you found on wherever online to get you that property. And we believed him because you're buying it out of state too, right? Like I'm remote. I'm here in Southern California. You might be in Washington. And on the other side of the country, we're relying on this realtor to tell us it's a move-in ready home rental, and we get the
Move in
appraisal back.
ready.
It comes, and I'm like, what the heck is this? I think last year or the year before, really like surprised me because I remember seeing one appraisal and I was like, holy cow, this is not what we were shown on photos on Zillow, and this appraisal looked completely different. And I was like, yeah, this is not going to work, sir. This condition's way off. And I'm sorry, you're out like $800 on your appraisal. It's a good thing you're not getting this house.
That's another really important point that we all cover in a lot of other videos too. Like, tell us the truth. Tell us the big picture, or else you're just going to be paying for an appraisal. Eventually, you're always going to have to pay for an appraisal for a DSCR. And then you're going to lose out on that appraisal money if you try to hide some details or just think it's going to slide. And we will tell you if it's going to work or not.
Yeah.
And save you that 800 potential dollars that you could and then they get mad at us, right?
It's always the lender's fault. This is where experience really comes into play. You have to run the deal. Like and it looked great. And especially with out-of-state investing, it's like you're trusting that person on the floor, out on the streets for you, right? To do that research and you get it back. And like, how did you come up with your projected rent? Who gave you the CMA, the market analysis, right? For that home? Was it Zillow or Redfin or Realtor.com? I mean, like, if that's the case, then I hope you're confident in the next steps. Cause like, again, I'm not a certified appraiser, so I don't have access to local market rents on an appraisal system in that state. But I'll double check with you as a customer and then confirm if the numbers work. But again, we'll eventually see the real numbers. So it's like, please.
No need. Yeah. There's no reason to lie.
Talk to the professionals that are helping you in the real estate side to confirm if it's a real rent. Like Zillow estimate doesn't work. It's always wrong. Zillow estimated values are way wrong on home value in most cases. So
yeah.
Again, it's you gotta do your market research, and that's when a lot of it comes to how much time you prepped yourself in the research. And again, it's like Peter, Nikki, and I aren't going to be able to tell you this is your exact home value or this is what your market rents are. We're going to use the same tools and information you provide, but hopefully you have ground level experience in the neighborhood because it's in your backyard of what you're investing in. That you should know, right? And then you should know what's real and not.
So if you're watching this video and you're actually serious about becoming a real estate investor, or you already are a real estate investor and you want to get into a DSCR, we have the tools that can help you. Like we said, there's going to be a link in the show notes or the pinned comment, and also the QR code floating around on the screen if you're watching this on TV. Schedule a call with us. It doesn't matter what stage of the process you're in. It doesn't matter to us how much experience you have in real estate investing. We're here for you. We're here to educate you and to help you get to the next steps, wherever that may be. So we hope to talk with you soon. If you are a regular subscriber, thanks for watching this all the way to the end. If you're a new viewer, please hit that subscribe, like button, share with your friends, share with your other investment buddies, and let's get a community going.
If you're subscribed for Christmas present, share our channel.
Give us the Christmas present by sharing our channel.
That way the
All right.
algorithm gets in front of more people so that we can help more people.
All right. Thanks for watching, everyone. See you guys in the next one. Thanks for watching. If you want to learn more about DSCR or HELOC, we're building out a playlist called Millionaire Mindset, and we're putting all of that content related to building real estate investment portfolios in a playlist, and you can click that on the bottom. If you want to see how millionaires use a HELOC and how it could benefit you, click the link on the top.